Good morning, ladies and gentlemen. Good morning, everyone of the banking industry in Ghana, beyond Ghana, in the corridors of Africa and the world, wherever you find yourself. Good morning from Ghana, and then you are welcome to joining us on this insightful webinar, which brings to you what the new financial reporting standard, IFRS 18, brings to bear. So with me, I have with me Dr. Kwabena Situ, and I also have Mrs. Charlotte Forson Abe, affectionately called Mama Shal in Deloitte. And we want to welcome you and then thank you for joining us. Last week, we had a wonderful session with those of you in Ghana, and then this week, you are joining us once again. We will zoom straight into the session, and the person to kickstart the session for us this morning is going to be um, Charlotte Forson Abe. So, Shal, we'd want to hear you. And Charlotte Forson Abe, Mrs., is the financial services leader of Deloitte Ghana. And so, Charlotte, if you can hear my voice, please, the floor is yours.
Thank you very much, Richard, and good morning once again to everyone. I am sure I can be heard very well. So it's
Good
a
morning,
pleasure to join us again this morning. As Richard mentioned, just last week we were on the guidelines from the banking sector. And what do we have today? So I think our host has actually introduced us to the topic. So IFRS 18 is a new standard, the new kid on the block. So this is a new accounting standard. And IFRS 18 is titled Presentation and Disclosure in Financial Statements. It was issued by the International Accounting Standards Board, that is the IASB, on the 9th of April 2024. What does this new standard aim to do? So it is to improve the quality of reporting, transparency, disclosure, and comparability of financial statements with the end users in mind. So you see, the standard keeps talking about the end users. So what benefits do the users have when they have the standard? It means that it's supposed to make our reporting better, in some. So this new standard is replacing IAS 1, that is the financial statement presentation. And it is effective for annual reporting periods beginning on or after 1st January 2027. That in a few months down the line, this standard will kick in and it will be effective. And it has a retrospective effect, which implies that the implementation of IFRS 18 will require companies to restate their December 2026 numbers. That is at the end of 31st December 2026, when we are doing the 2026 financials, will be expected to restate those numbers and also present a table or present a statement of financial position as at 1st January 2026. So really, the opening balances for 2026, we are in 2026 already. So the opening balances which we are using from this year, that is carrying from 31st December 2025, the year that just ended. So the opening balances that we are carrying from 31st December 2025 to 2026 will have to be restated. And then the 31st December 2026 numbers will also be restated because they will be the comparatives before we can now report the 2027 numbers. So the introduction of IFRS 18 is one of the most significant, in fact, it's the most significant change to reporting standards in over 20 years. So even if you look at the 17th and the 9th and all of that, this is a very significant reporting standard that has quite a number of changes. It is a major shift in several areas. And the most important one is on how the P&L, the profit and loss account, is presented. Because it's going to talk about how management-defined performance measures are disclosed and some additional requirements for grouping line items. So in grouping the line items, there are changes there. We'll see some. I don't want to give you the parts of the cake when I have Dr. Situ to give you the full picture. So yes, so there'll be major changes in how the numbers in the P&L are going to be reported. Quoting from ISB's own literature, the new standard aims to improve how companies communicate in their financial statements. The standard will increase transparency for investors and provide more comparable information about companies' financial performance to enhance investment decisions so that investments can make informed decisions. In this webinar, we will demonstrate some of the possible key changes. So please be attentive and alert for that. Inevitably, The impact of that change will go beyond the confines of the finance team, and it may affect how business managers look at their strategic communications, how they play their roles and responsibilities, core business processes, and data management. I believe that you will stay glued to the webinar and get all the necessary highlights that you will all need from IFRS 18. You are welcome to ask questions as we move along. We appreciate you once again for joining us today. I pray you all that you have an impactful session with Kobina, Richard, and myself. Thank you very much, Richard. I hand over back to you.
Thank you. Thank you so much, Charlotte. In fact, you have said a lot of things in your introductory remarks, giving the retrospective approach of the new standard, some areas of impact, the P&L, and business-wide impact of the financial statement. Now, I wouldn't want to worry you, but I would bring in Dr. Situ because, Doc, if you can hear me, please, we want to see your face. We are introducing a
I'm
new
here.
financial reporting standard to the banking industry.
Yeah.
The banks are very, very special,
Okay.
and I know somewhere the standard even
Hmm.
defines their activity specifically.
Hmm.
So you want to tell us from the
Yeah.
banking industry, what
Yeah.
are some of the things coming up from the IFRS 18?
Okay. Great. Great. Richard, thanks so much. And thanks to, I think, our participant, the banking industry. I think this shows that Deloitte really cares for the banking industry. And this is just a tip of the iceberg because there are more of such interactions to come. And as you said, we had one with the regulator and we continue to build on it. I think Charlotte said a lot of beautiful things that we will try to unpack within within the next minutes or so or an hour. But just to emphasize some of the important things, and then we zoom into the bank specific stuff, right? Because we need to understand and appreciate that one of the aims of the standard is to respond to the investors' demand, is to respond to the investment demand for better information. So that is very, very key. And then another aim of the standard was to improve the information, the information that is being communicated on the performance of entities. So that is another aim of the standard. Now, the third aim of the standard is to give investors a better basis for analysis. All right, so if you look at it, the aim of the standard was triggered by the investor needs and demands. So that is very, very important. Now, another point we need to also state is that the IFRS 18 carries forward most of the requirements within the IAS 1. It means that if you are conversant with most of the requirements in IAS 1, understanding and applying the IAS 18 becomes a bit easier for you. So that is also very important. And I also want to emphasize that this IFRS 18 will affect all entities. So no matter the industry in which you are, the IFRS 18 will definitely affect you. And I think we are going to see those things playing out. So, Richard, if you could just project for me that one pager slide that deals with some of the main requirements of the standard, and then I will pick it from there. And this is where we will need to probably pay particular attention to some important things that I am about to say. And if you look at paragraph 9, all right, and these things we are going to discuss is very, very important. It sets the tone, and then we now go into the banking specific things that we'll be dealing with, right? So if you look at paragraph 9, it tries to set the tone in terms of what financial statements actually do. All right, what financial statements actually do. So, Richard, you can look at it if you can see from a screen, but just to confirm, Do you hear me clearly? And do everyone see the
Loud,
screen?
loud. No, Dr. Situ, you are loud and clear. And if participants can give
Okay,
us thumbs up to let us know they can also
super.
hear you, the better.
So super. So Richard, you can read the first line in there for me because
Okay.
it set the tone. The IFRS 9 and the IFRS 18 paragraph 9 really set the tone of what the financial statement actually stands for. And if you look at some of the requirements, as I said, in IS 18, you realize that it carries forward most of the requirements in IS1. So, Richard, just do me a favor and then
Yes.
look at that line for me, please.
Okay. So if I read the first, and that is on the first statement on the
Yeah,
screen, is a financial statement.
yeah,
Provide financial information about a reporting entity's assets,
mm,
liabilities,
yeah,
equity,
yeah,
income, and expenses that is
exactly.
useful to users for financial statement in assessing the prospects for future net cash inflows to the entity and in
Mm.
assessing management stewardship of the entity's
So,
economic resources.
exactly. So Richard, in paragraph 9
Yeah.
of IFRS 18, there are very key points that we need to pay attention to because
Mhm.
it sets the tone for everything we are about to discuss. And if you understand paragraph 9, imbibing the rest of the paragraphs becomes very easy because you know why you are doing what you are doing. And what you are doing now is preparing the financial statement. Now, Richard, if you look at some of the key things there,
Yeah.
you are dealing with one, elements, right? The
Yes.
elements of the financial statement. And the elements of the financial statement, which we call economic resources. So the economic resources of any entity is the asset, the liabilities, and the equity. So you are dealing with the economic resources, number one. So since an entity is dealing with the economic resources of the entity, that is why in reflecting those economic resources of the entity, it is reflected on the balance sheet because then it gives you a snapshot of those economic resources. Now, the changes or the movement in those economic resources are reflected in the statement of profit and loss, right? It tells
Mhm.
you how well you've been able to manage those economic resources. So, i.e., the assets, the liabilities, the equity, how you have managed them. That is why at the tail end in paragraph 9, Richard, you read that those economic resources, the stewardship, it also it assesses management stewardship. In assessing management stewardship, basically, what it tries to do is how well have you or how well has management used those assets? How well has management been able to manage those liability and use those equity, right? So in the stewardship assessment, your financial statement will also tell you the story. Rita, there's also another key word there,
Yeah.
users of the financial statement.
Yeah.
So users of the financial, who are the users of the financial statement? So somebody will ask, is the taxman a user? Or is you, Richard, a user of the financial statement? Or is Mama Shah a user of the financial statement? Now, we need to be clear. The standard itself defines who are the users of the financial statement. And Richard, if you look at the conceptual framework,
Yes.
chapter 1, in the conceptual framework, it clearly is defined for you who are the users of the financial statement. And for those of you who are not so conversant with the conceptual framework, when we talk about the conceptual framework, basically it deals with these are the broad principles, or it contains the broad principles upon which these individual standards are developed. So you look at the conceptual framework, chapter 1, it clearly is defined for you who are the users of the financial statement, because nobody can just walk to you and say, I want this particular information in the financial statement. He or she must be a user of the financial statement. So in the conceptual framework, the users of the financial statement, which is clearly defined, are lenders, creditors, and other
Potential.
creditors. No. Let me
Potential
put it this way. Let me put it this way, Richard.
okay.
Investors. Okay,
Investors, yes.
let me put it in the right order. Investors, and when we deal with investors, we are dealing with existing investors and potential investors. So that is number one.
Okay.
Number two, creditors, or let me put it strictly per the conceptual framework, lenders, and then other creditors. So investors, existing and potential, and then lenders and other creditors. These are the well-defined users of the financial statement. So it means that anything we do in the financial statement must meet the needs of these users as defined in the conceptual framework, Richard. So in the paragraph 9, it clearly sets the tone and it breaks down what the financial statement actually stands for, what is it meant to do, who are the users of the financial statement, and what is the financial statement actually meant to do. So Richard, these are the elements that IFRS 18 paragraph 9 tries to expand on. And I think as we go
So,
along, you will
yes.
appreciate the paragraph 9 so well that everything we are going to talk about actually have a source in the paragraph 9. So Richard, I think I'll leave
Look.
it for you to
Uh-huh.
also touch on one or two things, and then I'll come in and talk about some of the key changes that IFRS 18 brings on board, especially in respect of the statement of the profit and loss. Thank you,
Okay.
boss.
All right. Thank you very much, Dr. Situ. That's very, very, very insightful. But I want to ask before you leave, talking about the users, are you invariably saying that these are the people who are causing this change to happen
Super,
in the
super,
standard?
spot on, Richard,
Okay.
spot on.
So it's not
These
just
are
the
the people.
IASB who has gone to sit
No,
somewhere and then
in
decided
fact,
to
the
bring this.
IASB, which actually I'm a member of their extension. So actually,
Mm.
I'm a member of the SMIC, that is the IFRS for SME implementation group, and I interact with them. And you realize that anything that we do, and Rita, last year we were also part
Yeah.
of the IFRS conference in London, and anything that they do is actually from what the investors are saying, whether existing investors or potential investors in the capital market. What are they saying? What
Mm.
are the lenders saying? And what are other creditors saying? That is what those are the people they want to actually satisfy. And this is buttressed, as I said, in the conceptual framework, clearly defining for you who are the users of the financial statement, and also buttressed by the IFRS 18 paragraph 9. So Richard, yes, thank
Okay,
you
now
very much.
thank you. I needed to ask this because I've been receiving a lot of questions and sometimes even criticisms that you accountants, you go and sit somewhere and you come up
No,
with
no, 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 no,
standards
no.
because you need money.
So Richard, even surprisingly, tax people
Yes.
are not even users. Tax people are
Yes.
not users. The
Okay.
tax GRA is not a user. So-
Yeah. That's quite interesting. And just to add from what you were saying, when I move into the paragraph 16, and as you can see, you have on your screen. So on your screen is a summary of all the areas that the standard actually talks about, which changes are coming in. So it's a summary that we have introduced, and then you want to look through with us. So when you look at the paragraph 16, the 16 actually talks to the primary financial information, what you call the primary financial statement. What are these primary financial statements and what is their role? And I have a copy of the standard with me, so I want to read from the standard so that you can actually also appreciate. We couldn't put everything because we don't want to make the slide so bulky for you. When you look at it, it says the role of the primary financial statement is to provide a structured summary of the reporting entities' recognized assets, liabilities, equity, income, and expenses, and the cash flow that are useful for the users of the financial statement. So what the 18 is bringing up is what you call the structured summaries of the entity's resources, obligations, incomes, and expenses, and their relationship with the equity participants. So that structured summary is what we need to understand from this perspective. And then the purpose for it is to make sure that people understand, or the users obtain an understandable overview of the assets and liabilities, equities, income, and expense of the business. And then also be able to make comparisons between entities, between reporting periods, or even within the entity. So those are some of the objectives. And then also to help identify items of areas for which users of the financial statement may need additional information. What it means is that the presentation must be clear and such that if there is anything in the financial statement that is not clear, users will now have the right to request for more information from you, the preparers. So that is what the paragraph, when you read the paragraph 16, is talking to. When you read from the paragraph 8 to 4, it's 18 to 24, it actually structures or tells you about the importance of the notes to the financial statement, where you have provided the summaries in the structure in the financial statement, be it the P&L, balance sheet, and the statement of changes in equity, and then the cash flows. Then when you go to the paragraph 18 to 24, and then when you expand it to the paragraph B9 and then B8 to 9, tells you about the importance of the notes, what you must do with the notes such that it complements what you are presenting in the financial statement. So we would give room for you to ask questions. So we will just summarize it in this way so that we can have regular, frequent interactions with you. So I'll pause here on the first part, which talks the primary financial statement, and then I'll come back to Dr. Situ. Dr. Situ, please, having said all this, what are some
Yeah.
of the key changes that the
So,
17, the 18
yeah.
is focusing
Okay.
on?
All right, Richard, thanks very much. And I think you have also said some important things that
Mhm,
I think in the beginning, I made a certain statement that most of the requirement in IAS 1
mhm.
has managed to find its way within IFRS 18. So you see that some of the things that you just said, we are used to in the IAS 1, right? But it
Yes.
has been carried forward within the IFRS 18. Now, where is the change coming from? And I think this is where we will need to digest it very well and
Yeah.
then now zooming into the bank specific.
Yeah.
Now, if you look at where the change is coming from, Richard, it's
Mhm.
coming from the statement of the profit and loss.
Yeah.
It is coming from the statement of profit or loss. So that is where the change is coming from. And if you look at from paragraph 46 down to, I think, paragraph 82, thereabout, that is where most of the major changes is playing out. Now, in paragraph 46, there is a statement that it makes. It says that, and it's very important we take note of it because
Mhm.
that also set the tone for why we prepare the statement of profit or loss. Now, in paragraph 46, it says that all items of income and expenses in a reporting period should be so all items of income and expenses in a reporting period should be reported in the statement of profit or loss. So paragraph 46 set the tone why we need to prepare statement of profit and loss. And it is very important because that gives accountants the basis why they say statement of profit or loss for the year ended, right? Because you are dealing with a certain period, and within that period, you want to put all items of income and expenses within that statement. Now, in that paragraph that I spoke about, you realize that five main things from paragraph 46 all the way to paragraph 82 thereabout, it spelled out five main things. it spells out five main things. What are these five main things? And Richard, I will mention the five main things, and
Okay.
then I will ask you to just speak on the other things. I'll come back to the five main things one by one because I'll need to quickly attend to something and come back to you, right? So I'll just mention the five main things, and then Rita, you can pick the other things, and then I'll come back and then dive into those specific things. Then, what are the five main things within that paragraph 46 to 82? Number one, within that paragraph, it talks about categories that needs to be in the statement of profit or loss. And there are five categories, which I will explain. Number two, it also talks about entities with specified main business activities, like the banks we are dealing with. This is where it becomes very interesting now, right? So it deals with entities with specified main business activities. Within the same paragraph, and remember, we are dealing with where the change is coming from. Number three, it also deals with the totals and subtotals that must be presented in the statement of profit or loss. And in this instance, there are three new subtotals that we need to look at. Three new subtotals that we need to look at. Number four, it also deals with items to be presented in the statement of profit or loss or disclosed in the notes. And this could be general disclosures or specific to banks. We will come back to it. And number five, within that range of paragraph, it deals with presentation and disclosures of, this is very important, of expenses classified in the operating category. So we will also deal with that one. How should expenses in the operating category, because one of the five categories is operating category. How should expenses within the operating category be classified? And we'll also go into that one. So these are five areas that within paragraph 46 and paragraph 82, it deals with, which we will dive into it. So Rita, please just take over. I will come back again and deal with these five things for our participants. So Richard,
Okay.
over to you. I'll come
All
back.
right. Okay. Thank you. Thank you so much,
When I
Dr.
come back, I will alert you. So you let me
All
know,
right.
right? Thank you.
Okay, cool. But we also be mindful of time because people would want to be wanting to hear from you. Yeah, but the interesting thing is, and it's good we actually have, he's actually breaking up because what you need to also appreciate is that before anything goes into the P&L, it must stem from the balance sheet or what you call the statement of financial position. And so we want to take a quick look at the statement of financial position as has been described this time around by the IFRS 18. And then once that is done, we can now move back into the P&L, and I'm sure Dr. Situ will be in by then. Now, when you look at the paragraph 96 all the way to 106, it talks to the structure of your statement of financial position, which invariably we call the balance sheet. Now, it outlines how it should look like and how you should consider your classifications. And it talks to your current and then non-current categorizations. And this one, it's still rooted from the IAS 1, as you already be aware. Howbeit, you now need to be sure what should be current and what should not be current. And the standard is now giving you specific indicators that you should be mindful of in putting anything as current or non-current. And where it introduces the banking space is the fact that ideally the standard is written, you see it from the manufacturing angle. However, it makes specific requirements to say that depending on your nature of business, you may present your items in the statement of financial position based on your liquidity. So you as a bank, you may not be doing anything so different when it comes to the statement of financial position. But when it gets into the P&L, that is where things will come out more clear as to what is happening now different. What you are looking at on the statement of financial position when we pick, or the main issue in there is the fact that people tend to misclassify or misoutline the items on the face of the statement of financial position, because the standard clearly would say that you would want to present it by the order of, let me use the word, hard liquidity to the less or soft liquidity. Now, when you pick most of you banks, their financial statement, you see that you have the first line coming as your cash and cash equivalents. Then you will now have maybe investments, which where sometimes there are a little bit of misclassifications or mispresentation, because in the investment, sometimes you see people presenting hard investments, for example, investments in, let me use the word associates, let me use associates. And then you now come to say investments in, let's say, your debt securities, then your investments in equity securities, etc. So those alignment must be checked. You need to stand to a particular principle to say that if you are doing the hard liquidity to the soft liquidity, then you need to follow suit properly. You don't want to mix and match them. And that is a key requirement that the standard is now bringing in that we look at. And then when you go further, it now outlines the various items that needs to be presented in the statement of financial position. So that is how the statement of financial position is looking like. And how bet you want to know that incomes or and expenses, before they flow into the P&L, must have an effect on the statement of your financial position before they flow into your P&L. And when anytime I mention this, what my mind doubles up is the financial statement actually starts from the statement of financial position. So you want to get your financial statement of financial position right by categorization, by presentation, by the lining of your items before you move everything into. So now, depending on the item on your P&L, on your statement of financial position, for example, when we pick your cash and cash equivalent, and you as a bank, you now want to find out what is the movement of the cash and cash equivalent, because your main nature of operations or your business has to do with what you call investing asset. And I know Dr. Situ will talk to that because he mentioned it. I didn't want to go into that. You are investing in certain assets, then it now triggers your classification in your P&L as to whether you have quote unquote operation, investing, or a financing activity, which Dr. Situ, when he comes, would throw more light on that one. So that is what you need to be aware of on the statement of financial position. When you look at the 18, it doesn't bring you enough, or let me say, huge difference as to what you are doing now. So whatever you are doing on there, I would say that you are okay, but you will need to check that in terms of alignment of the principles, in terms of the liquidity presentations, you are clearly aligned. And as to whether you want to keep something as current or non-current, you need to be sure to meet specific requirements in there before you can call something current or non-current. For example, let me use this one. You have, let's say, a loan covenant, or let's say an asset covenant with someone, and that is due within 12 months. Ideally, you are going to classify that loan asset as a current, and hence may come in by way of to say high liquidity. However, during, let's say, 2 months to the year or to the year end, there was how we call it, a breach of the loan covenant, and the guys come to say that, oh, I'm unable to settle you maybe within this 12 months, but if we can agree new terms to extend it. The moment the guy comes this way, it now calls for an assessment to say that, can we now go back and then sit as to tell whether the loan is sitting in will be classified as current or non-current. Now, what the 18 is now telling you is that You now need to go back to the new terms that you are going to agree with the guy. If the new terms are such that in the next 12 months, the settlement will not be possible, then it must be a non-current. But if you assess that in the next 12 months it is going to be, then you need to classify it as current. So those are some of the new changes that have come in on the statement of financial position. And at this moment, Charles, if you are here, you want to go into the chat box to see if there are questions in there so that I can pick them because we want to interact more with participants.
Yeah. So far there's no comments in the chat box.
And not also in the Q&A box. Okay, I see somebody raise their hand. Yeah.
Yeah.
So, Ben, if you can please allow participants to unmute so that they can tell us their question, ask their questions as well.
Hello, Richard.
Yes, good.
Good morning.
Good morning.
Okay, so in the introduction and the summaries from your end,
Yeah.
please correct me if I'm wrong. I heard you saying that the financial statements actually start from the statement of financial position,
Yes.
all the things in the income statement flows into it, impact it. And then my mind was babbling. You know, there are times that there are transactions that are not the entity's transactions. It's not part of your transaction, but it hits you. What am I saying? For example, a transaction with a related party directs you to do something on its behalf. Okay, so at the end of the day, the expenditure that you made, maybe you pay a supplier or a subcontractor on behalf of that related party. So money is going out of your cash and bank, you credit your cash and bank, and you are going to debit the related party receivable. For this transaction, it doesn't, even though it goes through the statement of financial position, it doesn't flow into the income statement. So that is where I was a bit jittery on that statement of yours that all the balance sheet items are
Okay.
come from the income statement.
Okay. All right. No. And I like your question because when you started it, you went straight into the balance sheet. You never came into the statement of financial position. That's why I said every transaction starts from the statement of financial position. Because the moment, for example, the related party ordered you, the first place you went into your cash, and your cash sits on your statement of financial position. Do you understand? If anything will have to move from there to the P&L, then it will now depend on a particular standard that will require that if a certain condition happens, then you move. So, for example, assuming the related party is not paying, then you now say that, oh, you have to amend or write it off. Then it now moves from your balance sheet into the P&L. Do you get it? So that is how you need to appreciate the whole financial statement from. Please, I
Thank
hope it
you.
clarifies. Yeah.
Very fine. Then my final question relates to Doc's presentation. He mentions that the IFRS 18 will cut across all industries for everybody, Does it mean that it also affects IFRS for SMEs as well? Because I know they have their own standards.
Okay. So IFRS 18 is not applicable to IFRS for SMEs in any way, because the IFRS for SMEs is a separate standard on its own or set of reporting platform on its own, and you don't mix it up with IFRS 18. Howbeit, in later years to come, the SME standards would also be amended so that they reflect what the main standards are also talking about. So that is what will happen. Yeah.
Grateful, great question, yeah.
Okay, cool. Thank you very much. All right. Whilst we still wait, hello.
Yeah, so there's a question in the chat
Okay,
box, the Q&A
please,
box.
you can read it for us, Charles.
Okay, they said, is there a Nigerian financial reporting standard That's guide on presentation and disclosures on
A
financial.
Nigerian.
Yes, that
Wow,
is.
that's an interesting question. So, so for so long as you are presenting your financial statement, you are required to indicate which set of jurisdiction or standards are you using. And if you are using IFRS, you are using IFRS. And so if you are deviating for IFRS, then you need to make the users know. As a matter of fact, when you go into the notes to the financial statement, one aspect that the 18 talks to clearly is what you call your statement of compliance. And the statement of compliance clearly indicates that you need to state which basis are you preparing your financial statement. If it is IFRS, let it be clear. But if you are deviating from IFRS, then you need to also disclose that clearly in the financial statement so that the users will know the basis at which they are going to assess the financial statement. So I hope it answers whoever asked the question.
Yeah,
Yeah. Okay, cool. Any other, please? Otherwise, I'll move on.
you can proceed. So far, it's only one question.
Okay, cool. So I'm also going to talk to, because we are on the statement of how do you call it, financial position. I'll talk to your presentations in the statement of changes in equity. So for this one too, similar to what you do under the IAS 1, it has also not changed significantly. And that's also stems from the fact that when you are presenting your financial statements, it's the same. And Dr. Situ mentioned that where you see the main change is on the P&L and the other areas that has been introduced. Now, what it required in a statement of changes in equity is number one, you need to also make sure that you are presenting a reconciliation of the movements from the opening to the closing. This one, it's something that you do, so you don't have to stress so much about it. However, if there are any new item that you are presenting in there, you need to clearly describe what it is and what impact that new item will have on your statement of financial, in the statement of changes in equity. So that's also very, very simple. So we call it the narrow scope changes or narrow changes that comes on in the standard. And then I'll move into the notes to the financial statement. And where in there, the 18 is requesting that you present your notes in a systematic manner to provide information necessary for the users to understand the line items presented in the primary financial statement. And here, this is where you need some more descriptions into whatever you put in the primary financial statement. And to supplement the financial statement, disclose material information in the notes if not presented in the primary financial statement. What happens here is that there are times that there are some information that you'd want to present, ideally you would want to present in the on the primary financial statement. And I'll say this because when you read other paragraphs of the standard and when you go to from 100 downwards, it will tell you that you are not restricted to some of these requirements in the standard. Howbeit, if you put anything different from what the standard is requesting, you need to provide sufficient information about the new things that you are putting in there so that the users would understand what you are putting in the financial statements. So those are some of the key highlights that you need to pay attention to in the notes when you are presenting them. And then in the notes, there are notes that you bring in, year out. And then there are notes that you carry forward, which the standard also mentions. For example, when it comes to the basis of preparation of financial statement, that one you need to make sure it is always there. The notes concerning your accounting policies must always be there in accordance with the principles of IAS 8. If there are estimations and then areas where you have uncertainties, you must also make sure that there is information about those estimates. And here, what we see, and let me use from what I have seen people do. people literally do not pay attention to those areas very well. In that sometimes when you talk about this estimation, they go and then normally the thing that you talk about is the useful life of your PPE. But when you pick your financial statement, you see that there are a lot more things that you do. You do provisions. Sometimes you do provisions for your employee benefits. All these are estimates. You do fair valuations. All these are estimates. You do impairments. All these are estimates. You need to provide adequate information about this. And this time around, the standard is making it more, let me use the word mandatorily and firm, that auditors must also review that all this information are outlined clearly in your financial statement. Capital management and other disclosure requirements. Here, what we have also noticed is that anytime you go into those notes, people will say, oh, there are no capital management issues, etc. I mean, from experience, you'll see that when you ask further questions, you will see that there are informations, but people literally are closing their minds off it. This time around, it's a more requirement that you do provide all this information when it comes to capital management and other dividend payment, etc. You need to provide a lot more information. Typically, what you see is the amount that has been approved, and then that's it. But you want to go down the share, the dividend per share, the quantity, the number of people you are paying, etc. You have to provide a lot more information as required by the new IFRS 18. Any question, please, Charles? Any question for us?
Yes, there is a question.
Okay, please put on.
So from Gabriel Krache, said, from what I've learned over the period, banks
Okay.
don't segregate current from non-current assets, and same for liabilities. But listening to your presentation, it seems to suggest that now they have to segregate, unless I didn't hear you right. Has there been any changes to this?
No. So that what I said was that whatever they were doing from the era of the IS1, it's okay. But then it is in the categorization or listing of the items is what they need to pay attention to, such that if you are going, for example, from high liquidity to less liquidity, you stay glued to that. You don't mix and match them. Okay. You can also equally introduce, and remember, it is here you are at liberty to do that. Introduce current and then the non-current grouping, but it is not mandatory. And if you are going to do it, you need to stick to your principle to make sure that whatever you are calling current is indeed current, will be settled within the next 12 months. Non-current will be settled after the next 12 months, etc. So those are the points that you need to be noting in there.
Okay, okay.
Yeah, please. Any hand up?
No question for now, and no hand up as well.
Okay, all right. So once we are still trying to get, because of time, I will move into another angle, and then when docs come, he will now come back to his P&L. So where I want to go to is identifying your specific business activity, and that also helps you in the presentation. Now, when you look at the standard, they introduce this diagram. The standard makes a statement in there to say that entities with specified main business activity. And this is where you as a bank, you come in. And if you pick from what I said earlier, you would see that I mentioned that the standard normally will be written from the manufacturing entity perspective, but then makes room for specified main business. And anytime the standard talks about specified main business, it is talking about an entity that invests in a financial asset. And that is where banks you get introduced, insurance companies you get introduced. And it differentiates you from all other forms of entities. And here you get to know how your classification is done. Under what circumstances must you classify something as either operating or investing, or put it as a financing item? So you go through this decision tree and then you ask these questions. For example, does the entity invest in financial asset? The moment you identify yes, or you answer this question yes, then we now need to classify in operating income and expenses from those specified assets. It makes it clear. Once you're able to tell what your specified business entity is, then all your incomes and expenses from that particular activity will now be going into your operating activities. And if you also assess that you also provide financing to customers as part of your specified or main business activity, then you are getting in there. Then we now have the question to say, does the income on expenses specified and in paragraph 4, paragraph 54 talks to your specified main activities from cash and cash equivalent relate to providing financing to customers? If the answer is yes, then your incomes and expenses must be going to where? Your operating activities. From this snapshot and what I've said so far, then what is mainly critical here is being able to identify what your main business activity is. And that main business activity or specified main business activity is what will now tell you what to put into your operating category or your investing category. And here it gets interesting. I'll pause here, and this is where you now move into the P&L proper. So don't want to rush this one, but take my time, answer questions, we can interact from here.
Okay.
Yeah.
So there's one question in the chat box,
Okay.
which I think is jumping a bit higher, but yeah, from Gabriel Kratche as well. I also want you to explain to me what IFRS 18 means when it says management defined performance measures. Clear,
Oh,
specific examples will be greatly appreciated. Thank you.
sure. So we will get into that because it's part of all those main changes that we will talk about. But for now, let's look at the classification, because that is, let me say, that is the heart of the standard. Yeah. So we will get to the MPMs for you. Okay. Any other? Please, anybody who want to open their mic and then. Okay, if there are no questions, so what is of critical importance is being able to identify your specified main business. So as a bank, the question is, what is your specified main business activity? Is it investment in financial assets, or are you there to provide financing to customers? And all banks, that is your specified business activity. So any income or expense that is coming from these two sets of activities, you have to classify them into your operating activities. So it means that on the P&L, when you are putting anything, income or expense coming from these activities, straight, it must go there. Then you now want to think about what will go into your investing activities as a bank. Now, when you look at your investing activities, let me use one scenario. Let's just say you're a bank and you have an investment in an associate entity. You would see that this associate entity, whatever you are invested in, is not a financial asset, number one. It is not the business of financing customers. So the income or the gain or loss from that associate entity cannot be classified in your investing or in your, operating activities. Those ones will now form part of your investment activities. So when you are trying to determine your income and expenses from your investment activity, that is where you now need to be heading towards so that you know what to put in there. Okay. The moment you answer no to your specified business activity and
Richard, I'm
provided.
back home.
Okay, Doc.
I've
Please
been back
let me
since, but I was just enjoying your flow. So.
let me finish this one and then maybe I'll invite you to come in, Doc.
Flow.
So the moment your answer goes to no to a specified business activity, then we now need to be able to tell what is that activity that you are operating that would help you classify your incomes and then expenses. But the moment you scope yourself out of providing investment in financial assets, you scope yourself out of providing financing to customers, then you now need to be thinking about classifying those activities, i.e., your investment in financial assets, you're providing financing to customers, into investing categories. That is how you want to start thinking about it. And the moment you start saying that no to this, then invariably you're also telling the story that you are not a bank. You are not a financial institution. And that is the interesting thing that this picture seems to tell. Dr. Situ,
Yes, boss.
I will
Yes, boss.
allow you to come in from here. People are beginning to hear from you.
So I hope you've touched on some key things that I wanted to touch on, like the categories in the statement of profit and loss. So the categories that is being introduced in the statement of profit and loss, I said there are 5 categories.
Yeah.
You've mentioned, I believe you've mentioned the operating category, the investing category, the financing category. Not only that, we are also dealing with the income tax category. Then we are also dealing with what we call the discontinued operations category. And the discontinued operation category is handled by IFRS 5. All right. So if you have such an item, then that category needs to be introduced. Now, so remember, Richard, and I think I mentioned 5 things that comes from the paragraph 46 to paragraph 82 thereabout, right? I mentioned the first one being the categories in the new statement of profit or loss. And then the second one that I mentioned, I think I've seen that you are showing it, is entities with specified main business activity. And I think I will touch on it because we are dealing with banks here.
Yes.
I'll touch on it. It has a lot of impact on the banks, all right? And then the third one that I mentioned within that paragraph is the totals and subtotals that needs to be presented in the statement of the profit and loss. And I said there are 3 new subtotals that we need to look at. Number 4, I also said that items to be presented in the statement of profit and loss or disclosed in the notes. They are general items and they are bank specific items. So if I say bank specific item, then it means that I'm talking about what the IFRS 9 specifically requires us to disclose in the note or on the face of the statement of profit and loss. And then the 5th thing that I also said was that when it comes to the presentation and disclosures of expenses classified in the operating category, and these are 2. So you can either do the expense category classification within the operating category, either by function or by nature. Either by function or by nature. And if you are doing it by function, it means that in the note, you need to disclose it by nature. All right. So, and that is very, very important. Then most of the banks, what I've seen in Ghana, they do the by, it's like a mixture of the 2, by function, by nature, thing like that. And also, we should also bear in mind what the various regulations also requires us to do. So, Richard, I can see you've touched on the first one, so I'll not waste too much time on it. So the operating, investing, financing, I think we are used to those headings because of cash flow, right?
Yes.
We are used to those headings because of cash flow. But the emphasis here is that when it comes to the profit and loss, we must be very, very careful here, because what the investors want to know, Richard, is that is this your operating profit really operational, coming from operating? And I think this is where the specified main business activities come in. Because as Richard was trying to explain to you, if a bank, you have landed on the conclusion that my specified main business activity, and Richard was saying something very, very important, and I hope you paid attention to it, because when it comes to entities with specified main business activity, you are either dealing with entities that are investing in assets, or entities that are providing finance to customers, or you can even do a mixture of the two, right, Richard? So
Yes.
you can so either you are an entity that is investing in assets, or you are an entity that is providing finance to a customer. And most of the banks, their main business activity is what? Is providing finance to customers. Now, you need to really settle on banking boot camp is coming. Richard, when is banking boot camp?
Oh, it's in July. So the
It's in
specific dates will
July.
be communicated soon.
Super,
Yeah.
super. I am really yearning for banking boot camp. Boy, the way I will digest these things for my people, they'll be surprised that Dr. Kwabnasi too is really a doctor. In fact, okay. So, guys, this is very important. The question as to, are you in a specified main business activity? I.e., are you an entity that is investing in assets, or are you an entity that is providing finance to customers? This question must be answered. Why? Because if you are not able to conclude very well on this question, it means that what needs to be in operating, because if you conclude that, okay, I am in I am in the specified main business activity, it means what I will put in operating, a normal entity will probably put in investing or financing. Right? So we need to answer that question very, very well. And Richard, we need to also bear in mind that when we are talking about entities that are investing in assets, we are dealing with examples of entities that invest in assets or are in asset investments, such as investment entities. So if you are an investment entity, for example, we can say that your specified main business activity is investing in assets. If you are in investment property, if you are an investment property entity, so what you do is probably real estate, so investment properties, you understand? Then it means your specified main business activity is actually investing in assets. If you are also an insurer, it means that your specified main business activity is also in investing in assets. Now, if you are an entity that provides financing to customers, like the banks and the finance lease entities. So the banks and the finance lease entities are entities which we will say that they are entities that provide finance to customers. So, and it's very interesting that within IFRS 18, they are even asking you that if you come to that conclusion where you belong, you must even disclose why you have concluded that way. So that disclosure must be there. All right, why you have concluded that you are either investing in asset business or you are an entity that provides financing to customers, because it changes a lot of the dynamics. It changes a lot of the dynamics. Now, Richard, you remember I said that the assessment of the main business activity also influences what comes into the subtotals.
Yes.
So the totals and the subtotals, which I said we have three main, new subtotals, is very, very important. So what are these subtotals? Three main new subtotals, because the rest of them we know them already.
Yeah.
The first subtotal we'll be dealing with is operating profit. So now we want to see that line item, operating profit. Okay. And what you call operating profit as a bank will be different from another entity in a different industry, all right, because of what you do. Then the next subtotal that we should be dealing with is profit before financing and income taxes. Profit before financing and income taxes, meaning that in between your operating profit and profit before financing and income taxes, that is where you are going to have your investing activities coming through. Like, for example, your share, if you have, if assuming you are not into a main business activity, right? Then it means items like share of profit and gain of disposal of, let's say, associate and joint ventures will be some of the items that will come through between the operating profit and profit before financing and income taxes, right? Then, if you are in the main business, specified main business activity, probably some of the items you are going to put before you get your operating profit or before you get your profit before financing and income taxes might be different. Okay, and this is very, very important. Now, the next new subtotal that we want to see is the profit before income taxes. Profit before income taxes. So in between profit before financing and income taxes and profit before income taxes, that is where you have the financing things, right? And I would have loved if we were in a classroom sort of to actually draw the things for you, to show you. So please don't miss the bootcamp, please. Don't miss the bootcamp in July. Guys, don't miss the bootcamp. So the financing activities will be items that will come in between the profit before financing and income taxes and profit before income taxes. Then after the profit before income tax, your income taxes come. Then if you have any discontinued operation, then you bring it, then you get your profit. So these are some of the subtotals and things that will be dealing with. For a typical bank, they are free. The standard says that they are free to introduce additional subtotals. So apart from the mandatory three subtotals that I've just mentioned, all right, and the mandatory being the operating profit, the profit before financing and income taxes, the profit before taxes. Apart from these mandatory subtotals, you are free as a bank to introduce your own subtotals. Because I know that for the banks, for example, they will have subtotals that will include things like net interest income, net fees and commissions, right? And things like that. So they are actually free to introduce these additional subtotals. So that is very, very, very important.
Hello, Dr. Situ. Please, hello, Kwabna. Charles, confirm if you can.
Yes,
I can be
yes,
heard.
Richard.
Yes, you can be heard.
Yes, Doc. Someone will just ask. Talking of this, the banks are allowed to introduce new subtotals. Previously, in the financial statement, someone will say that, "Oh, I have what you call total exceptional items." Can they do that?
Richard, it will be difficult to introduce that that exceptional item, unless it is really exceptional. It can still be done. It can still be done, but it needs to be explained.
Sure.
It needs to be explained. And Richard, there is something I also want to mention quickly because of time, so that we give people the room to ask questions. Because of time, there is also specific income and expenses things that we need to deal with, especially when it comes to the foreign exchange differences. So foreign exchange differences, ladies and gentlemen, unlike in the previous regime where we will have a bulk total, one bulk total that deals with just one line item, and you put it somewhere in the profit and loss, right? That just spells out that one line item, Forex, and you put the bulk figure there. No, this time around, Richard, those era is gone. Under the IFRS 18, if you have a foreign exchange difference, it needs to be spread across the operating, investing, financing, and income taxes. So if you have Forex difference, which relates to even taxes, you must separate it from the one relating to financing, the one relating to investing, and the one relating to operating in the statement of profit and loss. So in the statement of profit or loss, the Forex must be separated likewise. So this is one of the areas where we think when it comes to the actual implementation, there will be a lot of work that we need to do, apart from the new chart of accounts that we need to relook at. All right. Apart from the new chart of account that we need to relook at, the foreign exchange differences, we need to know the source, and that will drive where we need to put the foreign exchange difference. Do we put it before we get our operating profit, or do we put it before we get our profit before financing and taxes, or do we include it as part of the income taxes? All these things are implementation decisions that we need to cater for carefully. Richard, because of time,
Okay, yes.
you can come in and deal with, I think we should give room for the audience to ask their questions. And definitely at the boot camp, we will do a lot of work around
More detail.
the IFRS 18. And Richard, just to let
Yeah.
people in on the boot camp a bit, you know that the boot camp this time around, we are going to have 3 separate sessions, right? So there will be a general session that will deal with issues that will pertain to everybody within the banking industry. And then the following day, we are going to break into various classes. So we are going to have the regulatory class, we are going to have the reporting class, and we are going to have technology class. So it's going to be a very interesting bootcamp this time around in July. And I don't want them to miss it at all, because we will dive deep into some of these details. So this webinar is just to give you a very good idea of what we are dealing with. But like as I said, come to the bootcamp in July. Let's deal with matters before the year end, and we can help you also implement some of these new changes coming up. So Richard, over to
Okay.
you.
So Doc, don't go. I'll come back to you, but let's try and see. Charles, do you have questions in the chat box?
Oh, yes, a number of them.
Okay,
And
please read
there
out.
were some hands up as well.
Okay,
Let's start with that one. I think Madam Grace Nyaba, her hand
okay,
has been up for quite a long time.
okay.
Yeah.
Please read it. Okay, let's go. Madam Grace, you can unmute and then let us know what you have for us.
Okay. If Madam Grace is not there, we can, Edmond, you can please go ahead and speak.
My hand is down. Hold on. Let me lower it down.
Ah, okay, good.
Okay. So let me just go to the questions so we can
Okay.
proceed. Okay. So said from Alaji Jalo, what is the main objective of IFRS 18 and how does it improve upon IAS 1?
Oh, I thought you've answered that question,
I think
isn't it?
it was the third statement. Yeah.
So we will send the recording of the webinar. Please go and
Well,
listen to it
Alaji,
again.
in the interest of time, so we'll please get the recording. Thank you so much. Charles, the next one.
So from James Kusia Fomba, Good afternoon, says. What is the situation of investment in government T-bills and bonds, especially for banks? Which category do they go to? I think that's what it is.
So very simple, straightforward answer. Since the bank's main specified main business activity is providing finance to customers, now there are two ways of treating it, and please listen to it carefully. If you look at what we are still even projecting on the screen, you realize that there is even a point where there needs to be an accounting policy choice, right? Now, assuming that all things being equal, the one of the sources of providing finance to customers is coming from these bonds, all right? One of the sources is the bonds that you have invested or you have. It means that the bonds, the effects on all the bonds also forms part of your operating activity or your operating category. This is very, very important because the operating category is a default category. I don't know whether maybe it was mentioned. The operating category is a default category. All right, number one. Now, it means that number two, if you are not too sure where to put the effects or the returns, all right, of some of these instruments, then the default category you can put these things is the operating category. Now, if, for example, you are not too sure because you cannot separate the funds, because the funds, you might be using it for other things apart from you using it to provide finance to customers. If you cannot do that separation between the funds that you are specifically using to provide finance to customers and the other things you are using the funds for, then you have an accounting policy choice to make. And this is very important. You have an accounting policy choice to make, whether to include it in the investing or you have to include it in the operating. So an accounting policy choice will also be necessary here. So that is why in doing some of these classification, the standard also makes room for you to use judgments, because the use of judgment in these classifications are also very, very important. All right. So it is a case by case, and we need to take the specific facts into consideration before concluding on some of these things. That is why starting your implementation early is very important, because you will need to go through some of these processes before you can actually conclude on some of the things. So Richard, that is what I have to say.
Sure. There's a very interesting question here from Reginald. It says, from a banking perspective, how much incremental change will IFRS 18 really introduce? Given that many of us already report within quite heavy regulatory disclosure frameworks that already seek a measure of comparability across market players. And what is, and is there any credible sample reporting for banks that shows what good IFRS 18 implementation will actually look like in practice?
Reginald, you don't have a problem at all. There are a lot of resources available, especially Deloitte resources. Deloitte, we have a bunch of resources. That is why we want to showcase some of these things to you at the bootcamp. So, Reginald, let me see you at the bootcamp. We will showcase a lot of these resources so that you know that Deloitte, we are the best. So we have a lot of resources, Reginald. So no fears at all. Just come to the bootcamp. We will display a lot of these resources for you.
Okay. Thank you very much. I think, Doc, someone earlier asked on MPMs. Do you want to just summarize on in the interest of time? Yes.
Okay. Management define
performance measures.
Exactly. Richard, it's a very important one. But I think because of time, that's why I skipped it. Now, when it comes to management defined performance measures, we need to pay attention to what it is in the first place. So anytime you are dealing with management defined performance measure, you are dealing with a subtotal of income and expense. So it is a subtotal of income and expense. And there are three things we need to note here. The entity is using it to do their public communication outside the financial statement. So, it could be a ratio, it could be an adjusted indicator or something, but the main purpose of MPM is that it's being used as a public communication outside the financial statement. And also very importantly, it is not within something that the IFRS 18 or any other specific IFRS has defined. So for example, operating profit is a defined measure under IFRS 18, right? So operating profit cannot be an MPM. But if I say adjusted operating profit, meaning that I have adjusted it, I have done some adjustment in there, then it becomes an MPM. So an MPM is a subtotal of income and expenses that the entity uses for its public communication outside financial statement. That is number one. And it is also not anything listed within IFRS 18 or any specific IFRS accounting standard. You see, so as long as an IFRS accounting standard or IFRS 18 brings that indicator, specifically says that operating profit before financing, and so it is something which IFRS 18 has defined already. It cannot be an MPM. MPM will be adjusted operating profit, things like that. And so that is basically it. And an item like, so if I say, for example, free cash flow, is free cash flow an MPM? No. Or yes, free cash flow, is it an MPM? It is not an MPM because it is not a subtotal of income or expense in the first place. So in the first place, an MPM should be a subtotal of income and expense, and then you can pick it from there.
All right.
So
Okay. Thank
Richard,
you.
I'll need to run now.
Okay.
So you can do the knowledge check now.
Okay, no, before I come back here, I just want to just mention a couple of challenges that we anticipate coming up with the 18 and its implementation. And Dr. Situ rightly mentioned one of them, which has to do with the Forex. The fact that you need to be able to identify the various sources of the transactions that is triggering the source of the Forex. It's something that entities must now go deep into it. And so you need to now go back, sit down and look at your transactions one by one. And if you have derivatives gains and losses as well, you need to now go back and tell the story. Where is this loss coming from? Is it coming from an operating activity, investing activity, or financing activity? So that exposure, we anticipate that entities are going to struggle in there. And so you are welcome to call on us. We are here, and that is what our work, and that's what we do. We take the time and then do it for you. And I know certainly there will be areas of judgment we can come in and then help you come up with. One other challenge has to do with consolidation, and I like it from the question that came from reporting from diverse markets. It means you are likely to be preparing consolidated financial statements. You need to make sure that all your subsidiaries line up, or in terms of their grouping or categorizations, are seamless and the same across board. From one entity to the other entity, you need to make sure that everyone aligns to whatever the parent has. So we foresee that you are going to have some challenges there. You are welcome to also call on us when it gets there. And then also the need to start early because the standard is only effective from 1st January 2027, as Charlotte mentioned at the beginning of the session. What it means is that if you have not started to do some of these things that we have mentioned, then you are more or less behind time. And so you need to start working on it now because if you don't, it will just catch up with you and you have to rush through things and you will not do things the way it should go. And also, one other area of challenge is having to develop your MPMs. It's also an area that we believe that you should pay attention to, and we are also here to support you in that. So that being said, I think Charles, you are welcome to let us know if there are questions in the chat box or any hand is up. Otherwise, we are also mindful with time. But then before we go, we can quickly do this. You are welcome to send your answer through the chat box so that we see. So just a couple. How should an entity with no specified business activity classify dividends from investment in equity instruments in the profit or loss? And here the answer is the entity with no specified business activity. So that dividend from investment in equity, is it going to be dividend received, financing, investing, or operating activity? Please let us know your answer. Charles, let me know who has answered.
Okay.
Yeah. Somebody, those who ask me questions, who spoke specifically, I'm going to call their names and then let them answer. Do you have answers?
Yes,
Okay.
Edmond.
Uh-huh. Is it
Same
a
financing.
dividend? He said financing. Oh, wow. Very interesting. Yes, any other?
Only Edmond has answered so far.
Yes, please, anyone to answer. We want to have more feedback so that we know that at least there is some level of understanding from what we have discussed. It helps us.
There is a hand up. I don't know if
Okay. Please, the person can speak to it.
Stephen Moore.
Stephen. Stephen, if your hand is up, please, you are welcome to answer.
Before Stephen comes in, there are some answers in the chat box. So
Okay,
from
let's know what is happening.
James is saying investing. Then
James is saying investing. Mhm.
and Albert is also saying investing.
Albert investing.
Uh, Jax is also
Jack
saying
is saying
investing.
investing.
Then there are quite a number of investing in the
Emmanuel investing,
French investing. Kwame, yes.
investing. Yeah, and the answer is indeed investing because the entity does not have a the entity does not have a specified business, and that means that it will go into a default of investing because it will be seen as an investment activity. Okay, now let's try the next one. Let me see. What are the two new subtotals that entities are required to present in the statement of profit or loss? This one, Dr. Situ mentioned it. Anybody to try? Hmm. Charles, do you have answers?
Albert is saying B.
B.
Seeing profits and profit before financing and income taxes.
So B. Okay.
Quite a number
Mindful,
of these.
number of B's.
James,
Okay.
Jax, Edmond, they are all saying B.
Okay. So B, we will go for B. And then how should interest income on cash and cash equivalents be classified for an entity that does not have a specified main business activity according to IFRS 18? Very interesting one. Yeah.
No questions yet. No answers
No
yet.
answers.
Yeah. Believe they are thinking about it.
Okay. I think somebody has raised the hand. Maybe he wants to answer it. But we are mindful of time, so please keep it quick and then we will wrap up.
French, Prince
Uh-huh.
Quick Arthur.
Yeah, Prince, please, let's know.
Okay, before Prince comes in, Emmanuel said other operating income.
Mm-hmm.
James also saying financing.
Hey, Emmanuel, other operating income. Here we are dealing with either it is operating, financing, or investing. Okay, financing. Okay, let's see what in the interest of time, let's see what the answer is. It's investing. It's investing. Remember, your interest income from cash and cash equivalent. It's an income because it's more or less something that you have invested and you don't have any specified business activity. So it falls within your investing activities. Yeah. Okay. So I think that brings us to
Richard, you see,
yes,
that
Doc.
was what I was talking about, that
Yeah.
we need to be careful. So if you don't have any specified business activity, right? So you
Yes.
are not a bank, or you are not providing finance to customers, or you are not investing in assets. It means that if you have interest income coming from such cash and cash equivalent, it cannot go into what? Operating.
Yeah.
You see, it cannot go into operating. Rather, it goes into the financing category, the investing category. You see, so we will need to really settle our understanding on what
Yeah.
we really mean by specified main business activity
Yeah.
before some
So,
of
so,
these classifications can be done.
so what I will say is that anybody who had a wrong answer must come for the boot camp at all cost.
Obviously, obviously.
All right, okay. So, the banking industry, ladies and gentlemen, I think our time is up. We want to appreciate you so much for joining us this morning for this webinar. Jacob, please, if you are welcome to send us your question, and then we will address it for you and then share it across. Our time is up. But Dr. Sito, any final comments, words from your side?
No, I think, Richard, the message is clear. At least.
Hello, Doc.
Hello,
Hello. Yes.
Richard. So I think the message is very clear.
Mm.
We will need to deep dive into 18
Yeah.
again at the boot camp. They shouldn't miss it at all. We've been able to at least churn out some pieces of information on 18 out there for everybody, but we really want to get our hands dirty on this 18 before the implementation kicks in next year, right? 2027. So let's get our hands dirty at the boot camp, and then let's start the implementation. Let's start the process early, and then we can pick it from there. So see you guys at the boot camp, and this year's boot camp in July is going to be awesome. We have well packaged things for you. So in fact, start registering,
Yeah, Doc,
and
so
paying in
someone was
advance.
asking for you to throw more light on the boot camp.
Okay.
So, Richard, do you want to do that?
Okay, let me just so the boot camp will be held in the at the Crown Forest Hotel in Gomoa, and it's a time where we bring all financial institutions together, and then we go through things that pertains to bank in terms of learning. There's a lot of fun activities as well that we do. The first of its kind happened last year, and then this year is going to be the second. And so you want to be part. Come network, come learn. We'll communicate the price and then the specific dates and then the schedule for the bootcamp in due course. Thank you all. Shal, I see you are on. Do you want to give us final remarks and then we can allow participants to go?
Oh, Richard, thank you. I think it's been very insightful. The start is deep. That's what I'll say. So we'll definitely have to make time to ensure that we get into them, into everything that is required. And then, as Kovna says, I'm sure the boot camp we will unpack a lot more. So
Sure.
hope to see a lot of us at the bootcamp. Thank you.
Okay. Thank you very much, everyone, and we really appreciate you joining us. IFRS 18 has
And Mama Shah will be at the boot camp too. Mama Shah.
Oh, excellent. She's always there. Yeah, IFRS 18 has come to stay. You have your systems to also look like your chart of accounts, your classifications, accounting policies to develop. Please, you may need hands, and in fact, you need hands. Please let us know. Reach out to myself, Dr. Situ, Shah, anybody from Deloitte, and then we will be there to assist you. Thank you all, and we will share you the link for this recording, for the recording of this webinar, just in case you want to have a playback. We really appreciate having you and your support. Thank you, and have a good day.
Work together, subsidiary of IFRS, and this section is quite an insightful one.
Life is complex. Everything interconnected, in constant flux. A simple shift in focus.
It's been awesome. It's been impactful. The first ever 2025 banking bootcamp for CFOs. From the very first day, it's been one level of insight into the other, one level of impact to the other.
And the most significant area, particularly IFRS 7, we miss it a lot.
The cornerstone of our audit is understanding your client business. So if you don't take time to understand it, then you start from the wrong perspective.
Someone trusting that you act fairly and don't is also shown in that particular.
This is all of those bits and pieces. They are all account services. So don't get it twisted that financial institutions, financial centers are agents of life. So all play all. Please, this
If you ask me to rate the program itself in terms of an overall evaluation, I'll give it an A+. It's such a very wonderful program. I'll give it an A+, and the content is good. Selected topics that are being dealt with are very, very relevant to our work. The facilitators are quite superb, very, very superb, having very experience in the various topics that they mentioned. The examples they gave quite relevant. The case studies that we mentioned were very, very good.
So my name is Damilare Adewoyi. Work with Feather, a subsidiary of IFRS.